The Federal Reserve is likely to cut interest rates by around 0.75 to 1 percentage point in 2024. Now, this is going to be extremely bullish for real estate investment trusts who have been hammered over the last year or so. Today's episode, we're going to look at 4 strong REITs to buy now. We're going to take a look at one, however, to sell. We're going to run through our reasons why for each one. As always, we'll also look at the historical performance, we'll look at their dividend safety, we'll go through the financial metrics that support the numbers, and for each one of these companies, we will run through the valuation model, getting to our intrinsic value, as well as our acceptable buy price, considering our margin of safety, and looking towards Wall Street to see what they're forecasting over the next 12 months. Now, at the end of the episode, we'll also consider a REIT ETF, iShares Global REIT. If this is one you are looking to consider, we'll run through some of the details for those who prefer an ETF as opposed to individual stocks. So the first strong REIT that we are looking to buy now, it is Prologis. Now, this is up around 7.5% over the last 12 months. Do bear in mind these numbers don't include those dividends reinvested. And over the last 10 years, a strong 216%. And we can see here all-time highs of around $170 around December 2021 as well as April 2022. Currently, we can see it is in the mid to upper end of the 52-week range. It does offer a yield just under 3% and a P to FFO just under 24. In terms of the dividend safety, well, it has a score of 61. It does look to be safe. Market cap, $121 billion. It is a mega cap company. In terms of those recessionary metrics, well, they cut the dividend during the last recession, 07-09. They had negative 80% sales, well below the average growth, which was negative 12. And we can see they massively trailed the S&P, negative 84 to the S&P 500's negative 55 return. Dividend growth, however, their latest increase just last month, a double-digit 10%. Love to see that as a dividend growth investor. 13% on average over the last 5 years, very strong. But do note, over the last 20 years, on average, it has been at 0%. And we can see here from this graph, in fact, they did cut that dividend, as we mentioned, in 2008. In terms of number of years, well, they have increased them for the last 10 years consecutively, with paying a dividend for the last 12 years without a reduction. In terms of dividend yield theory, as always, it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign here of undervaluation, 2.98 versus the 5-year average of 2.5. And we do note, however, the forward P to FFO is pretty much in line with the 5-year average. And as we always say, we don't look at any of these in isolation. We will conclude towards the end. And we can see the real estate sector P to FFO is much lower at 13.5. In terms of the payout ratios, while we do like to look at the free cash flow for REITs, they are a lot more volatile, so we'll draw your attention to the adjusted FFO, the funds from operation. Below 75% is what we target when we're looking at industrial REITs in particular. Over the last 10 years, they have been pretty much below that every single year. We do note the more recent year, 70% below the 75% target. But we can see expected next year to climb up to 87%. So something just to bear in mind. It isn't the worst case or a red flag indicator, but we can see we would like to see it a little bit lower than the expected for next year. AFFO, well, it has been increasing over the last 10 years. 146 in 2014, 495 in 2023, but we do want to point out that it is expected to decrease slightly into 2024 to around $4.43. In terms of the adjusted FFO per growth, well, it has been actually very strong over the last 10 years, double digit nearly every single year, although in the more recent year, negative 1%, and we can see there is an expectation that it will fall into 2024. In terms of the actual numbers to the top line, where we want to see steady moderate growth for REITs at 5 to 10%, and every year they have been pretty much around that target. In fact, the last 2 years, much stronger, 22% to the top line in 2022, 33 in 2023. In terms of numericals, well, 1.9 billion in 2014 to 8.33 in 2023. Now, for those that are new to REITs, they do essentially dilute your position. It is very typical over the longer term. The reason for this, well, they do need to issue equity to fund their property acquisitions, as they retain a little of that internally generated cash flow after paying dividends. So it has increased from 506 million to 952. As we go along today in the episode, you will see that different REITs will dilute your position at a different rate, some faster than others. ROIC, well, for REITs, we want to see 3 to 5% just to give us that faith that management are able to effectively allocate their capital. We can see over the longer term, it is around that 3 to 4%, so not too bad. In more recent term at 4%, it is pretty decent. Don't want to see it come down to the 2% we saw in 2014 or 2015. Margins looking very good. Operating margin, in fact, operating efficiency is noted from the increase in the margin from 24% to 41% in 2023. So that is a positive sign. And what we need to look at now in relation to the dividend safety as well as the balance sheet strength is the net debt to the EBITDA, the earnings before the interest, the tax, the depreciation and the amortization. We want to see below 5 essentially for industrial REITs, and we can see it has been decreasing over the longer term. Nonetheless, it is still above that in 2023 at 5.23, but we can see 2024 expected to come down to 4.86, which is positive. So based on the information, it does look like the dividend is safe for now. It is coming below 5, and although the adjusted FFO payout has increased to above that 75%, it isn't a red flag indicator for now, just something to keep an eye on. So let's get to the valuation of this company. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on this channel, we do run through every single one of these models to get to the intrinsic value. For today's episode, let's just get straight into the final calculation. And for Prologis, we get to an intrinsic value of $156. Margin of safety then, as always, we start off with the 10% that we use if it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, it looks to be a buy up to $140, at 15% up to $132, at 20% not quite there yet. So we see between a 15 to 20% MOS level based on our estimates and judgments today. In terms of Wall Street, well, they forecast a price target of $151 over the next 12 months with upside of 17%. They do see this stock as a strong buy now. As we do go through this today, do let us know your comments for each of these stocks, whether or not you are adding or maybe you're waiting for a certain price target. Just to let you know, we have released our latest free weekly article. If you want to gain access to this as well as all of the other articles, all completely free, do click on that pinned comment below where you can sign up and gain instant access. The next stock is Mid-America Apartment Communities, ticker symbol MAA, down 14% over the last 12 months. Over the last 10 years, however, you would be up 96%, and we can see they are somewhere away from their all-time highs of $229, and they are trading towards the lower end of the 52-week range with a yield of 4.51% and a P to FFO forward-looking of 14.53. Dividend looks to be very safe, a score of 97, market cap 15 billion. It is a large cap company. Recessionary metrics, well, they maintained the dividend during the last recession. They had plus 1.2% sales, so above the negative 12, but they did have a near recession return of negative 51%. Dividend growth been fairly decent, 5% last December, so above that minimum 4% we advocate on the channel just to keep up in line with inflation. 9% over the last 5 years, nice high single digit growth. Over the last 20 years, at a bare minimum, they are at least keeping up in line with inflation, and we can see they have been increasing those dividends for the last 13 years, whilst paying a dividend for the last 29 without a reduction. In terms of dividend yield theory, well, we have here a double severe sign of undervaluation. The yield is much higher than the 5-year average of 3.19, and the forward P to FFO at 16.2 is well below their rolling 5-year average, but it is still slightly higher than the real estate sector at 13.5. Adjusted funds from operation, well, consistently below the 90% blanket rule we use for REITs. In fact, 2023 at 68% was a very strong number, although we do know it is expected to increase slightly to 73% in 2024. Adjusted funds from operation, well, that is increasing year on year. Very positive to note, nearly doubled it across the last 10 years, although we can see it is expected to drop into 2024. In terms percentage-wise, Overall, pretty strong. We do see some years where it was negative, notably 2017. Other than that, we do see some strong years of double-digit growth, and the more recent year at 7% does look fairly attractive. In terms of the 5 to 10% sales growth target, we can see hitting that nearly every year. More recent year of 6% isn't too bad either. So numerically, when we take a look, they have more than doubled their top line from just under 1 billion to 2.15. As I mentioned earlier, different REITs will increase your position at a different rate. We can see here they have increased it from 75 million to 117, although we note from 2017 they haven't really issued a massive amount of equity over that period. ROIC, nice to note it has been increasing, and the last 2 years at 6% does look very strong for MAA. In terms of the operating margin, we can also see it has been increasing, although marginally year on year, 31-32% over the last 2 years, again fairly solid for this real estate investment trust. Net debt to EBITDA, very, very positive. Not only is it decreasing, over the last 6-7 years it is below that 5.5, 3.59 in 2023, expected to be pretty much the same in 2024, so absolutely no issues with the dividend, and we can see why it has that 97 very safe score. In terms of the valuation, let's get to that intrinsic value. And don't forget, you can grab a copy of this model if you want to get to the intrinsic value or the acceptable buy price of companies in your own portfolio or those in your watch list by clicking on that pinned comment below. So if we get to a margin of safety of 10%, we can see it buy up to 144.53, at 15% up to 136.50, and at 20% not quite there yet, but really not far off. So we see at least a 15 to 20% margin of safety with MAA on the current trading value. In terms of Wall Street, well, they have upside of 17%. They do consider this again to be a strong buy alongside Prologis, with a price target of $152 over the next 12 months. We then move on to the next REIT, which is PSA Public Storage. Now they're down around 4% over the last 12 months. Over the last 10 years, they are up 72%, and we can see all-time highs of $393. Currently trading in the midpoint of the 52-week range with a yield of 4.3% and a forward P to FFO of 16.5. Another very safe dividend score of 96, market cap 49 billion, a large cap company. And in the last recession, again similar to the majority of REITs, they maintained the dividend. They had average growth, but they did outperform the S&P with their negative 38% return. Dividend growth, so we're still waiting on a dividend increase this year. Last 5 years, 8%. Last 20 years, double digits year on year, so looking very positive. And we can see they've only really been increasing those dividends for the last year, and they have, however, been paying a dividend for the last 43 without a reduction. In terms of dividend yield theory, again, a double sign of undervaluation with that yield of 4.33 above the 5-year average, and the forward P to AFFO below the 5-year average of 22.2. It is, however, notably above the real estate sector P to AFFO. In terms of the payout ratio, well, below 90% consistently year on year, 83 in 2023, expected to be pretty much not too far off that in 2024 at 81%. Adjusted funds from operation, we don't see it in massive increases year on year, not massively consistent either, but we can note over the last 10 years it has doubled and is expected to increase into 2024. So when we look at it in terms of percentage wise, we do actually see double digit growth in 21-22, 6% in 2023, and still expecting an increase, although smaller than the previous 3 years at 3% in 2024. In terms of sales growth, well, they do hit that 5-10% for the majority of the last 10 years, coming in at a 7% in 2023. And if you want to see the numbers, they have essentially doubled their top line over the last 10 years. And this will probably be one of those REITs that doesn't really dilute your position over the longer term, really only increasing it by 3 million shares over the 10 years. So that is positive to note. On top of that, an incredible ROIC, as we can see, double digits every single year, 12% in the more recent year. So this is a REIT with a lot of strong metrics, so don't take that for granted. And we can see their operating margin very strong in the 50s area, 51 in 2023 as well. So lots to love with this company. And again, another incredible metric, even though it has been increasing, 2.68 in 2023, 2.56 in 2024 expected, still looking very, very positive for PSA. In terms of the valuation, so let's get to that intrinsic value, and for today's episode it comes to around $322. We can see with our margin of safety at 10%, a buy up to 290, and then we can take a look at 15%, a buy up to 273. So not quite there yet, so we see around a 10 to 15% margin of safety. In terms of Wall Street and their forecast, well, they have a price target of $315, so they do see it as a buy with upside of 14%. And don't forget to let us know your thoughts in the comments below as we go along. The next stock that we are taking a look at is DLR Digital Realty Trust, up 34% over the last 12 months. Over the last 10 years, up an incredible 186%. And we can see their all-time highs at $177. Currently in the mid to upper end of the 52-week range with a yield of 3.42%, a forward P to FFO of 21.46. Dividend safety does look to be safe with a score of 80, 45 billion market cap, so it is a large cap company. And in the last recession, in fact, they increased the dividend, which you don't see typically for REITs. They had plus 21% recession sales and significantly outperformed the S&P, so lots of positives to take. Now, they haven't increased their dividend since 2022, although over the last 5 years and over the last 10 years, we see 4 to 5% increases on average. So we can see, whilst there are no increases over the last year, we do see, in fact, 19 years of paying the dividend without a reduction. Now, based on dividend yield theory, we see a sign of reasonable valuation. The current yield isn't too far off the 5-year average, and we also note the forward P to FO isn't too far off that 5-year average of 21.2, but it is notably larger than the real estate's 13.5. In terms of the adjusted funds from operation, again below 90% consistently, 84 in 2023, expected to go lower slightly in 2024 to 80%, so still looking very positive with regards to that metric. When we look at the AFFO per share, it is increasing over the longer term, but we do see some years where it does decrease, so a little bit inconsistent. But again, 2024 is expected to increase from 2023's $5.84. And we can see here in actual fact, over the last 10 years, 4 of those years have been negative adjusted FFO growth. And in terms of the sales growth, we do see that 5 to 10% as a minimum for the majority of the last 10 years. Last year, in fact, strong double-digit growth of 16%. Numerically then, we see they've around tripled their top line from 1.63 billion to 5.45, and we can see what is typical, that dilution over the longer term. When we move to the ROIC, this isn't really what we want to see, that 2%, so I would say that is a little bit of a red flag indicator, something just to consider and maybe factor that into your MOS level that we will use for the valuation. And on the operating margin side, whilst 13 to 14% isn't typically the worst for a REIT, we can see it has been decreasing. So again, something just to consider when you are factoring that into your margin of safety. Net debt to EBITDA has pretty much straddled around the 5.5 consistently over the last 10 years, although positive to note, it is expected to come down to 5.69 in 2024, a lot closer to the 5.5 level that we like to see. In terms of the valuation for DLR, and that is quite important, especially if it is one that you are either invested in or considering to invest in, an intrinsic value comes to $159. Now, when we use our MOS, as always, 10%, a buy up to 143. At 15%, it isn't quite there yet, so we do see between 10 to 15% for Digital Realty Trust. In terms of Wall Street, well, they have a forecasted price of $150. They do see upside to this REIT, but only of 6%. So we can see this isn't one of the REITs where they would say is a strong buy when we do compare it to the others. Nonetheless, there is some upside. And as always, let us know whether or not this is one you do hold, continue to hold, or maybe you're looking to sell. The next REIT we are taking a look at is one that we do believe should be more of a sell than a buy. It is LTC Properties, now down 6% over the last year. Over the last 10 years, you would be down 16%, and we can see it is in a downward trend with all-time highs sitting around that 2016 $55 mark. It is currently trading in the mid to lower end of the 52-week range with a yield of 7.12% and a forward P to FFO of 12.07. We have a dividend safety score of 40, unsafe, market cap of 1.38 billion, a small cap company. And when we take a look at the metrics for the last recession, they maintain the dividend above average growth and also outperform the S&P. In terms of dividend growth, well, we can see they haven't increased that dividend in quite some time, although on average over the last 20 years it has increased by 6%, and we can see from this graph it has been pretty much maintained since 2017, but they have in fact been paying a dividend for the last 21 years without a reduction. Now, in terms of that dividend yield theory, and this is why it's important to never look at these models in isolation, we would see two signs here of undervaluation: yield higher than the 5-year average and the forward P to FO lower than the 5-year average, and quite in fact lower than the real estate's 13.5. Now, in terms of the adjusted funds from operation payout for senior living REITs, we do look at 80% if we want to be specific. We can see, in fact, for the majority of the last 10 years, it has been above that, 83 in 2023, expected still to be higher than that at 82% in 2024. On top of that, when we look at the adjusted funds from operations per share, we can see it is very inconsistent, very minimal movement over the last 10 years, and there is expected a very small increase into 2024. When we take a look at it percentage-wise, again, we can see not the greatest of growth over the last 10 years. 18% negative in 2021, 3% in 2023, and 2% expected in 2024. When we do, however, take a look at sales growth over the last 2 years, they have had increases of double digits, although we note the previous 2 years of negative growth. So numerically speaking, they still have increased their top line by 118 million to 192. On top of that, whilst they have diluted your position over the longer term, we can see it isn't the worst, and in fact isn't as much as some of the previous companies we've reviewed in today's episode. ROIC has been decreasing, but again, the last few years not looking too bad, 5 to 6%. In fact, as we mentioned, we do want to see at least 3 to 5. In terms of the operating margin, it has been decreasing over the longer term. Nonetheless, 54, 57% over the last few years is looking positive for this REIT. But we can see one of the areas that we don't like, on top of the adjusted funds from operation payout being quite high, is the fact that their net debt to EBITDA has been increasing over the last 10 years. 5.51 is much higher than the 4.5 that we want to see, even though it is expected to reduce down to 5.37 into 2024, still much higher, and it does give a worry for that dividend safety, especially given how high that yield is and how high that payout ratio is, something just to consider. So in terms of the valuation for LTC Properties, let's find out. And don't forget, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety then, 10%. We can see here in today's episode that the acceptable buy would be $28.56, nowhere near that current trading price. 5% again, it isn't. So what we can in fact see in today's episode, the intrinsic value is lower than the current price. So we do believe, in fact, the stock right now is currently trading at a premium. In terms of Wall Street and their forecast over the next 12 months, well, they believe there is upside to the stock of around 5%, with their targeted price of $33.83. As always, though, do let us know your thoughts in the comments below. As we did mention though, these are stocks for people who want to buy individual REITs. However, for people who are looking just to get into an ETF to reduce their exposure, one consideration could be iShares Global REIT ETF. Now, the expense ratio is sitting around 0.14%. And in terms of the holdings, you can see here some of these that we have talked about today. In fact, their largest holding by 8.7% is Prologis that we did run through. We've run through Equinix on another episode, which is a very strong real estate investment trust to consider as well. And we can see here we have Public Storage, PSA, which we covered today, as well as DLR, and also in other episodes, Realty Income and LTC Properties. But we can see here, these are the weightings of the top 10 holdings. As always, though, it really does come down to the individual investor, whether or not this is something they are looking at as an ETF. You also have Vanguard's VNQ, which we can cover on another episode. As always, though, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you on the next one. Take care for now.